If you want to pick stocks smarter, avoiding the risk of crashes and bankruptcies because you believe this is a path to life-changing wealth, I'm going to explain exactly how and show you the results of how I applied it. What I'm going to share with you isn't commonly taught out there, and to be honest, most financial analysts will probably hate me for saying this. But the truth is, the common methods of it's got great earnings, pays a great dividend, it's a big company, or it's gone up a lot, no longer works in a world of disruption, tariffs, and conflict. We're living through what many call the fourth industrial revolution, and the winners are coming out of nowhere and dominating. What's worse, the world seems to be in a winner-takes-all environment. So this is something you need to pay attention to if you're going to create the life-changing wealth you desire. Now, I know traditional advice warns against stock picking, so in this video, I'll address the 5 major objections in detail towards the end. Be sure to watch through till then. If I leave anything out, feel free to leave a comment or question below. I'm Emlyn. I've done thousands of trades and investments over the last 20 years. For the first 15 years, I barely beat the S&P 500, but 6 years ago, everything clicked. Since then, I've made 8 investments, with the best one returned more than 20 times and the worst one is down 4%. There has to be one. But the secret is, I've gone down the rabbit hole to understand companies, their stocks, and how they behave in market crashes and booms. This lets me take advantage and create life-changing wealth. But before getting here, I had to do something uncomfortable. Let go of traditional advice. Traditional advice is fine for saving, but as I'll explain in a moment, it will never create life-changing wealth. Quick disclaimer, I'm not a financial advisor, and this isn't financial advice, it's guidance. It's important to do your own research. The problem, what do you buy? This is the big question, because you're building savings and you're looking for a way it can be used better to build wealth, to maybe retire young, leave a soul-sucking corporate job, or just have more options in life. The traditional advice says buy broad market index funds, buy dividend-paying stocks for passive income, put your money in high interest-bearing accounts, or buy bonds and watch compounding make you rich. But if you're like me and did this for a while, you will have realized it's painfully slow and doesn't even guarantee a comfortable retirement at 60. After inflation and taxes, you make almost no progress. Meanwhile, companies like Google, Amazon, and Facebook come out of nowhere and go from nothing to be worth hundreds of billions of dollars in less than a decade. While seeing this, I thought, surely there's a trick I'm missing. Most of the gains are coming from these new companies. That got me digging further into how I could benefit from them. Because most of the stock market gains were coming from them, why not learn how to skip straight to where the real wealth is being created and avoid the other 490 companies in the S&P 500 that are mostly going nowhere? This is a key question I had to answer if I was to pick stocks smarter. Where is real wealth being created and why are most companies going nowhere? What I gradually learned over time is that for most companies, the CEO gets people excited by saying, we're going to grow revenue by some big number, we're going to increase earnings, we're going to reduce costs to show you how well we're doing, we're paying you a great dividend and buying back stock, increasing earnings per share. This gets people excited, the stock price goes up, getting even more people excited, and the price goes up even further as FOMO kicks in. The problem I realized over time is that it's really just financial engineering that makes the numbers look good. And CEOs and the boards have become great at delivering the numbers Wall Street wants. Stock buybacks and cutting costs, mainly through cutting people, is an immediate high for any earnings report. But this doesn't actually create real value for anyone except management through bonuses. Most of the financial world has lost touch with this fundamental requirement, and it's why most companies are supposed to exist in the first place. Stellantis and how their share price screamed higher in 2023 and crashed since the middle of last year is a textbook example of this. The high they created through financial engineering only lasted a few months, but they're not the only ones and won't be the last. New companies like Google, Amazon, and Netflix were creating real value. Google through things like a great search function when the internet was young and clunky, Amazon through disrupting physical bookstores and then creating cloud services, and Netflix through disrupting physical video stores and allowing people to watch amazing entertainment in the comfort of their home. This undeniable value creation for ordinary people meant they would always win. They didn't have to rely on superficial financial engineering to make numbers look good. Earnings reports could be occasional progress updates, which is what they're supposed to be, instead of the main event. Here's how I applied it. 10 years ago, I was following all of the common advice, buying ETFs, dividend-paying stocks, and putting money into high interest-bearing accounts, going nowhere and getting really despondent and frustrated. Then after seeing Apple, Amazon, Google, Netflix, and Facebook shoot the lights out, I thought, How can I be a part of that? Because that's what I need to create life-changing wealth. So because of climate change and electric vehicles having a part to play, Tesla caught my eye. Now forget what you know about Tesla today. 10 years ago, they were a small fledgling car company that most said were doomed to fail. Most financial analysts, including all of Wall Street, wrote them off. Many weren't even covering them. They were saying things like Tesla has nothing compared to the financial resources of industry giants like VW, GM, or Toyota. They're making cars intense, they need to raise money, they're going bankrupt, and no American car company has gone from zero to making over 500,000 cars in over 100 years. The odds are impossibly against them. This is typical mainstream thinking. This also explains why Wall Street missed Tesla, along with Nvidia and Palantir and most great stocks, only noticing them when they were impossible to ignore. Now back to the point of real value creation versus who's doing the financial engineering hocus pocus. GM was doing okay, but despite needing a bailout in the 2008 financial crisis, they clearly hadn't learned their lesson. Their business was still geared toward big trucks that couldn't be sold in most of the world because they're large and everyone's moving away from gas guzzlers. The business remained vulnerable. Toyota was a decent company, not really working on anything great, and VW had actually been caught cheating on emissions, creating a huge scandal that hammered their stock price. The story of these three companies was the general state of the industry. Tesla, on the other hand, was building electric cars, something the whole world needed and couldn't do without. They were the only ones creating undeniable value for the world in this area, meaning as long as they could build the cars, they would always be sold out. I also dug further into Tesla. I went through some of their patents and the way they build their cars and factories. Two things really stuck out at me for why they were special. Did you know a car can have up to 8 cooling systems? One each for the engine, battery, air conditioning, power electronics, front electric drive units, rear electric drive units, and supporting high voltage components. It's because as the car became more complex and we needed maybe air conditioning, instead of expanding the existing cooling system, a new one was added. Worse, car companies like Ford and GM outsourced the manufacture of these cooling units to many different companies. I can't think of a bigger nightmare in bringing all this together. Tesla had just one for everything. Also, Tesla developed their own electric motors, the most efficient in the world at the time. They even designed their own magnets that went into them. This was clear evidence of undeniable value creation. But this went completely over the heads of Wall Street and other financial analysts and journalists. So while they were obsessed with Tesla needing to raise money, I bought it at $15.80 in June 2019. I remember most of my colleagues laughing at me for buying into a nearly bankrupt wannabe car company with a manic CEO. Within a year, the stock went up 20 times. I got some congratulations and mostly silence. But the same thinking can be applied to Bitcoin, which creates undeniable value through empowering people by giving them reliable access to a store of value, protecting them from ravaging inflation. For millions excluded from the global financial system, it gives them a means of selling goods and services globally. That's great if you're in an emerging market. So I bought it at $19,000 in the middle of 2022. Or SoFi. In finance, the banking industry has been racked by scandals that have destroyed trust among consumers. Further, so much banking in the US takes place on decades-old technology like checks. SoFi, with its values, leadership, and holistic digital platform, aims to change this. I bought it at $676 in 2022. SoFi is the new company against traditional finance, which has been mostly stuck. Or Palantir and their creation of custom AI platforms for businesses in a way no one else is doing. I bought it at $926 in 2022 and got out earlier this year at $123.95 with a 13.94 times return in 3 years. But traditional advice says stock picking is bad. Objection 1. The vast majority of professional stock pickers fail to beat the market. Reports show that 88 to 95% of US active mutual fund managers underperform their benchmark over 15 to 20 year periods. If full-time professionals with PhDs, billion-dollar research budgets, and instant access to corporate management can't consistently win, the average individual has almost no chance. I used to read a lot of analyst reports about which companies are hot, should be followed and invested in. And to be honest, I do think they're mostly garbage. They say so many things wrapped in financial jargon, sound very smart talking about all sorts of ratios and metrics that it loses ordinary people. Then they mostly reason by analogy and really tie anything back to how the company creates value. These are the people who make the financial engineering arguments I spoke about earlier. The process I describe is completely different. Objection 2. You are competing against professionals and algorithms. Today, you're not just up against other retail investors, you're trading against Renaissance Technologies, Citadel, Jane Street, and other high-frequency trading firms that see your order before it hits the market and front-run it legally. The individual investor is the slowest money at the table. The odds of day trading are indeed heavily stacked against the individual investor and favor those with resources. But Warren Buffett has been the slow money for decades, and look how well he did. I'm arguing for good long-term investing that will change your life. I would add that the current state of the world puts it at a unique point in time where disruption, tariffs, and rapid global change have reset the playing field for everyone. This is why new players are coming out of nowhere and dominating. Because this space is new for everyone, you can have a massive advantage over the financial analyst sticking to the traditional playbook. Objection 3. Survivorship bias and data mining fool people into thinking it's easy. Stories of Apple, Amazon, Tesla, or Nvidia 100x returns dominate headlines. But for every one of those, there are thousands of Enrons, Pets.com, Sears, Blockbuster, and Lehman Brothers that went to zero. The winners are visible. The graveyards of destroyed companies are invisible. The graveyard is littered with companies that became old, complacent, arrogant, stopped innovating, and thought things would never change. They're easy to spot. All the great companies today had something special going for them, which you can discover if you do your homework. For example, before I invested in SoFi, Tesla, or Palantir, I liked watching interviews of the CEOs explaining how their products work and why people will love them. A good CEO can explain this clearly in high detail and is passionate about it. But listen to most CEOs, like those of Mercedes, VW, Toyota, GM, and Ford, which I did listen to, and you mostly hear the financial engineering jargon I keep mentioning. You really hear specifics about why their products are special, what sets them apart, and why customers will love them over others. Objection 4. Concentration risk is enormous. Even if you somehow pick a winner, holding only 5 to 20 stocks means one bad event, accounting fraud, bad CEO, disruptive competitor, lawsuit, etc., can permanently impair decades of savings. Diversification is the only free lunch in investing. Stock pickers voluntarily give it up. I'm going to go even further and say you only need 5 good stocks to change your life. As Warren Buffett once said, diversification is protection against ignorance. It makes little sense if you know what you're doing. The truth is, diversification is no free lunch. It dilutes your attention and your returns. In reality, you achieve more by doing less. As for a single bad event like accounting fraud or bad CEO impairing years of savings, when you do your homework, you can spot CEOs, especially founding CEOs, their leadership teams, who are passionate about what they do, whether they care deeply about the mission they're trying to accomplish. Follow them long enough and you can get comfortable with whether they live and breathe values strong enough to stay away from bad behavior. Again, it's often the guys talking mainly financial engineering that you have to worry about. They show you beautiful charts, yet underdeliver on promise after promise, and then blame market conditions for poor performance. The pressure on them to deliver when they're not working on anything with real added value is a powerful incentive to engage in bad behavior. Objection 5. You need to be right twice. Buy and sell. Even if you correctly identify a great company, you still have to time the exit correctly. Many people own Netflix, Amazon, or Tesla at the right time and sold far too early because it went up so much already. For this one, I'm going to point you to this video I did on when to buy and when to sell. I mean, I did pick up Tesla at 1580, SoFi, Bitcoin, and Palantir in the 2022 tech crash. In this uncertain world we live in, may you find the financial freedom to live the life you want to live. Good luck.